Je hebt het logo zo, hè, van die busy season talk. Zet jij er zo op? Ja, mooi. Alright. Hi all. Take a seat. Thank you. So we'll continue, and I'm very happy that we have a real interesting session coming up, and it's being hosted by what we call the Busy Season Talks. It's a group of young professionals who, I think on a weekly basis, discuss why are we auditors? What's the audit profession? Why are we on earth? And they have good and in-depth discussions that will help everybody who is an auditor or studying auditors or whatever. So I'm very happy that you're willing to have this session here in front of us, because this is something you do virtual, I think, on a weekly basis, mostly. Yeah, right. So it's great to have you here. I just have that from the website. We make everything negotiable but light-hearted. So that's great. You share experiences, tips, and fun stories. So we just had this discussion and the surveys that implicate that auditors are boring or audit is boring. And I tell you, no way, because you see people sitting here. And I will introduce the two hosts, and the hosts will introduce the members. And I start with Charlie Groen, sitting here. She is Senior Associate Philosophy and Purpose Culture Behavior Transformation at PwC. And in Dutch it's aanjager, so that's enhancer of the faculty ethics culture of the NBA, the Dutch Institute. So welcome, and nice to have you here, Charlie. And the other host will be Mitchell de Caluwe. He's accountant, manager assurance at EY, and public policy and regulatory office, and board member and host of this is even a stichting association, Business Season Talks. Ladies and gentlemen, the floor is yours.
Thank you. Thank you, Philip, and thank you for the kind words. Welcome everybody to the FAR conference. We're happy to be here for a second time in a row. Last year we were here as well. Philip already introduced us a bit, but yes, we are making a podcast. We are a lively a platform community discussing all the things about developments in the audit practice, but in a fun, light-hearted way. And we share experiences, tips, great stories between students, but also executives, regulators, and everyone interested in our field. Usually we make this podcast, so this is a live session, so this is a bit new for us, but very fun. And if you are interested, we're making in Clubhouse, but we're also on Spotify. So if you're interested, just follow us on Spotify, and you will hear more about us. But before we introduce our guest and the subject, we want to ask you also to be interactive with us. So during the sessions, you can ask questions. We have the catch box, the Busy Season Talks catch box. And yeah, that's it. So we're gonna make a fun 40 minutes for it. Charlie, can you introduce our first guest?
Yes, all right. Good to be here, and nice to see you all. So let's start with Frank Verbeeten. He's a professor at the University of Amsterdam. I'm sorry, and immediately my voice goes out. Sorry about that. He specializes in accounting, management accounting, and internal control systems in organizations. He's published many publications already in top-tier scientific journals. He sits in many boards as well and has internal roles. So we're very, very happy to have you here. Thank you for coming.
Yeah, thanks for having me.
And our second guest is Marnix Pouw. He's a dedicated audit practitioner at Deloitte. And also leader of the Global Young Forum, where they discuss experiences of young professionals globally. So we are very happy that you are here, and valuable. Maybe you can share valuable insights from a practitioner perspective. And last but certainly not least, we have Claudia Marangoni. She is an assistant professor at the Tilburg University. She did research about myopics behavior, decision making, and we are very excited to have you here and have your insights from your research. Thank you.
Yeah. So all our guests have experience with our main topic, which is, and hopefully they can give us more insights into, measuring the unmeasurable. I'm so sorry about my voice. Because, as you know, much more non-financial information is becoming more important into the audit practice. ESG reporting, the CSRD standards, but also already included are the soft controls. What exactly is going on inside organizations? How can they fulfill their ambitions on these topics, especially if we talk about the S of ESG as well? And how do we measure that? Because and then also how can we give professional judgment about these more immeasurable, intangible assets? So let me first start with you, Claudia, because I heard Rachel introduced your work into myopic behaviors, and I first had to Google what that was. So maybe you could enlighten us a little bit about your current research and specifically this topic.
Yeah, sure. Thank you everyone for being here, and to the organizers for arranging this panel. So when it comes to myopic behavior, specifically in accounting, but more generally, it means that the decision making is short-term oriented at the expense of long-term value creation. And in terms specifically of accounting choices, it means that firms and managers in particular take decisions that benefit the firm in the short term at the expense of long-term value creation. And just to give you an example of a current working paper I'm working on, my co-author and I don't know if it's okay. My co-authors and I look at when firms have trade-offs between short and long-term orientation, and they decide to prioritize the short-term goals at the expense of long-term value creation. This actually has negative consequences for the culture within the organization, which is exactly the topic of these soft and non-financial specific characteristics. But this has also implications and consequences for the financial performance of the firm in the long term. So it's really this kind of, and I actually like the fact that ESG will be brought up today, because I don't think that's very much detached from the financial performance. They can be seen as two faces of the same coin, and I think that the best way is really to try and look at them as a unique and coherent set of things. So yeah.
Yeah. Thank you. And Marnix, how do you see that in your practice? The more non-financial that has become more important.
Yeah. So I want to. First of all, thanks for having me, and great to be at the FAR conference again. So if we talk about non-financial information, I want to make 3 points. So the first of all, I'm not sure if everyone has looked at the ASML annual report lately, but if you look in there, the first 200 pages or so, I think it has 380 pages or something. The first 200 pages or more, 213, is non-financial information. Then somehow they start with the financial statements, the historical financial information. And then at page 288, you get an auditor's report on the non-financial information. So non-financial information already exists today, and I think it will just be evolving in the coming years, but it's already there. So with regards to non-financial information, at least my perspective as an auditor, financial auditor as background, I think is that the fundamentals of auditing information, whether it is financial or non-financial, will remain the same. So for every client or every company that is reporting on non-financial information, we still have to make an assessment about what is important to their stakeholders. Where do we see the risk of them presenting something on non-financial information which is maybe materially misleading? And we then have to carry out procedures, right? So both controls and substantive work. And the third thing is, and that's probably something we will talk about more, is that there's probably a lot of non-financial information where auditors are not very specialized in. But that isn't very different to what we do today. Because if I look at my audits, we also have a lot of valuation specialists. We have tax experts. We have all kinds of specialists. So the need for specialism is always there and will be there still with non-financial information and even more. So that are my first thoughts when we speak about non-financial information.
Very interesting also. Oh, hello. All right. And Frank, how do you relate to this? I mean, ASML, very innovative company. How does, for instance, the organizational internal systems, the control environment support their success? And how do you assess this, or how does it relate to your work?
Yeah. First of all, disclaimer, I'm not an auditor, so I look at the management accounting and the finance function, and I've been looking at how intangibles are measured and what are they relate to value creation. I think there are a couple of things, I agree mostly with my previous discussants, but I think one key issue with the non-financials is that we're aiming for something, which is the outcome, and we sometimes mistake it with the output that we're actually measuring. And for example, I'm not sure how ASML, I'm not sure about how they do it internally, but I'm not sure whether they measure innovation and reward it versus that they eventually become a very innovative company. So there's a difference there. The second issue is that I am very much in favor of ESG. I'm not sure whether it brings that what we're all hoping for, in a sense that if you consider ESG as, let's say, you should behave ethically. That's something else than versus we have a long-term versus short-term time orientation, and the consequence of that difference is how we look at ESG has an impact on how or what accountants can do. If you say they have to follow the regulation, that can be done. If you have to say beyond that, like, okay, is this measure, if we increase this, will it result in value creation in the long term? I think that's a very difficult claim to make. Yeah. So that I think there's going to be the issue for the companies.
What are the main challenges from a managerial perspective?
I think there are two. So I mean, CFOs are looking probably for long-term value creation indeed. So I think that there are two. We did a survey project in 2021 where 96% of the CFOs said ESG is very important to us. So I thought, okay, that's reassuring. But then the other issue was like 2/3 of them did not have the information or good quality information in order to make the right decisions. So the quality of the information and getting the right information from the information systems, I think that's one key issue. The other thing is last year we asked people, okay, what are you aiming for? What is your company aiming for? Is that compliance or is that new business model value creation? 2/3 of them said we're looking at compliance. So if ESG is only, let's make sure that we live up to the regulation and nothing more, I think that the regulation misses the point. The hopeful thing is that a lot of people are saying that we're currently looking at the compliance because we need to get it done for next year. But we see people changing in terms of how their minds are developing, like, okay, this is what we have to do, but it gives us new chances in this and this opportunity. So hopefully in the short term, then it's compliance, but in the long term, it means that we're looking differently at how to do business.
Yeah, and Claudia, is that also something you see because you looked at the behavior of?
Well, I think that what we observe is that really when there is a lot of interaction between this short-term and long-term perspective, but of course so far, and I'm pretty sad saying that, but only in a negative way, right? So being always focused on the short-term is at the expense of the long term. So at least in the data, and I have to admit that for data limitation purposes or reasons, we focus on the US setting, but and it's also a very specific setting because we only look at when companies do secondary equity offerings. So it's a very special setting, and I don't want to generalize, and hopefully there's hope. But it's really this kind of vicious circle where the short-term perspective also leads to long-term negative consequences in the ESG world, let's say, in addition to financial performance. So it's kind of.
And can you give a little bit more explanation as to I don't know if your research covers this or what ideas you have? Why these myopic behaviors are so prevalent?
Yeah, so there is actually a key, I would say, common theme, and I think that this is something that auditors might keep in mind, let's say, always, and probably they do that already, but it's really the incentives, like the topic of incentives, right? Try and understand what drives firms behaving in a certain way. And for example, the specific setting I have in mind at the moment is when companies are in these specific kind of situations, they want to maximize the issuing price, right? And therefore, they want to try to look as good as possible on paper. And this leads them to cut certain expenses abnormally, at least that's what we observe, at the expense, in this case again, of the employees. Now, if you create a work environment where the employees feel demotivated and under pressure, that clearly has consequences because they become less productive, and if they become less productive, the company achieves lower financial performance. And this is not something that manifests within 1 year, but can actually drag over more than 1 year. So that's the kind of negative circle, unfortunately, that I mentioned. But that I was discussing with some of my colleagues last week, and I said I would really like to find a setting where we can observe, based of course driven by theory, the opposite. So when this kind of positive long-term happens, I'm still struggling finding a setting where this might be actually going on, but again, hope is the last to abandon us, so yeah.
Marnix, maybe you can give some more insight into how you already maybe observe these kind of behaviors at your clients that you do audits with, and how do you interact or integrate that into your audit work?
Yeah, absolutely. So I think also coming back, and I think Claudia and Frank also alluded to that, is that the company's business model should have long-term targets, goals. I think the role of us as auditors is not to assess whether a business model works or whether it not works. It's their, let's say, own business model, which they probably have to sell to their stakeholders and say that this is a good business model or not. We are not there to assess that, whether they are sustainable or not. I think that is not our role. It is very important, though, that companies define that and then determine how they are going to measure and how they are going to build up their systems to get that information and to report to their stakeholders on how that's going to do that. That's where I think, and I just wanted to say that I fully agree with Frank, that is also a little bit my concern, is that companies not have yet fully thought about how am I going to measure the non-financial information and how do I make sure that I can report on that liably. If you talk about the incentive part, also, I would say that is not very different to what we do today as auditors. So one of the most important topics these days for auditors is fraud risks, right? Yeah. So when we assess fraud risks, when we perform procedures on fraud risks, the most important thing we look at is what is management's incentive. Now it's currently a lot financial. You see a lot of compensation by management is based on non-financial and financial information. I think financial information or financial targets is most predominant at the moment. Might be more becoming non-financial information. So that is something we have to build in our procedures. So that is where management maybe wants to greenwash, as we call it, as a risk, to say, well, we look as a company, we look very good, I've met all of my targets, but we have to actually audit whether they have met those targets and when it is indeed, as they say that it is. So that is the expectation that on I think from our perspective, our stakeholders, regulators, the public interest will have on us as auditors, that we will verify that.
Yeah, very well said. I think we have a question from the audience.
There it is. Well, I think one of the things that is very important is that companies do have the incentive, and that is the people. Because if they don't work on their ESG, and it's not only compliance, I think, if they don't work at the longer term goals, then the people will not buy their projects, not go and work there. So there are a lot of incentives for them to also really look at the real goal of the ESG regulation. So I think that is an important thing. And from an auditor's perspective, I think there comes in the going concern discussion. And of course, yesterday it was already on the screen that it is an important topic. And only the going concern normally was the financial information was leading. And now we also have to look at the non-financial information. But not only on that, but also on the goals of the company. So I think how well, maybe Frank, you mentioned that you're afraid for the short-term goals and not looking at the longer term, and how is that being dealt with in investigations or in
This is not research based yet, at least. But this is when I talk to CFOs. So some of them are saying, okay, we want to get the younger. Philip, thanks by the way for calling me a young professional, because that's been a while since I've been called that. But getting back to that, a lot of companies are trying to get the younger people in, so to say, and they're saying, but they're already intrinsically motivated to help, the company forward in these goals. But then we get to the issue that was just mentioned. If you start motivating them just based on monetary issues like make your profits, and if, again, the same survey, 75% has a financial target, 25% has ESG targets in reward systems at the lower level in the company. So if you're only rewarded on profits while your boss says, oh, ESG is very important, but you're only rewarded on profit, that at one point in time it's going to match. And there are some talks that the younger generation is for that reason also leaving these firms. So they have to do something. On the other hand, if I may, sorry, but on the other hand, what you also may get is that if you start rewarding people on ESG targets, that is like saying like, okay, but I was already working on that. That was my idea to work on that. So now I'm getting paid, but the target that the company wants to achieve is maybe not the issue that I wanted to achieve by myself. And then you get also the issue like, okay, is this the right incentive for these people to work with?
Maybe they don't look at the rewards anymore. Well, of course, they always look a little bit at the rewards, but I think the young people do intend to believe that's real incentive, like the reward of the money that they earn. Yeah. It's more like, am I making an impact?
Yeah.
So I think that is an important thing, but also the customers, because customers do have a lot of influence, and not only the investors, but also the customers, if they don't buy the products anymore. So I think if people or companies only look at the short goal, then it's very important that they miss maybe the codec moments, and they have a real problem with their going concern.
Yeah, I just wanted to ask for clarification. Like, how do you then motivate your employees on the ESG topics? How does that work?
For example, companies do have targets on CO2 emissions, like if they are achieved at a certain unit, the unit or the people in the unit get a bonus based on that. So that's a way to do that.
Yeah.
But again, if you're, let's say...
But that's the E, right? That's the most, I think, easy to measure one of the ESG. And we also have the social and the governance structures. And do you have, or maybe also, Claudia, you can speak to that. Like, are there examples of this?
This is a little bit of an indirect way, but for example, now, and this goes back a little bit to the point that was raised about creating awareness of what is the culture within the organization, because I think that is the social dimension, right? Yeah. And for example, and this is also something that we start using in research more and more, are these kind of reviews that the employees do of their employers, and these are made available, publicly available, right? So if you're a customer and you're very, let's say, concerned that the company is not really treating the employees very well, which means being myopic and not thinking about the long-term perspective, you might have a look at those reviews and then say, well, I'd rather buy the product of another client or of another company because that is actually better. So let's say that is not a pure direct measure, but that's, I would say, one of the closest one or the best proxies that at the moment we have to measure the social component of what kind of environment. I mean, there is some recent research that with surveys tries to extract information about how do you measure culture, but then we always tend to be pretty abstract. We talk about values and norms. Whereas if you look at what the employees give a rating to what is the cultural values of the company, what are the senior management, how is the senior management treating you? Would you recommend this employer to other people, right? I think that these are more tangible ways to try and proxy. It's not internal. I mean, it's internal, but it's also used externally. So it's a kind of a little bit in between. And I think that that might be a way that auditors, I'm not saying they need to look it up themselves, but they can get internal surveys, let's say, to the client to try and get a feeling of what is going on there, to better understand what are the incentives, what are the drivers of managers' behavior. Yeah. Are they putting pressure on the employees, and therefore the employees might actually make mistakes or do it intentionally? So these kind of things, yeah.
Yeah, and it sounds real like soft controls. Yeah. And I think soft controls are really in place in our audit. Marnix, are you looking at these surveys or something within the company you audit?
If you ask me on a personal note, I think that we spend too less time on that, to be honest. So obviously, let's say culture and controls in general, whether they are, let's say, harder controls or the softer controls like culture controls are extremely important, and that isn't going to change under financial information and non-financial information. So that is something I think, and you see that in all of the discussions about the debate of auditors where they fail to do a proper job. Then if you really look at what happened, there's almost always something to say about that they didn't really understand the culture. They really didn't think through on where management or the people there were incentivized, or they didn't really feel what was going on. Therefore, I always encourage my people to go to the client, because that's the only way how you can measure it from our side. So not obviously with the survey as well. And so I think over the years, our focus has been really increasing on this softer element. So we look a lot at, let's say, the ethical code. What are they doing in terms of policies? If I look in a company, do I see speak up lines? You know, those are the softer elements where you can make it a little bit more tangible for us also in order to use that to understand how the company is working and how that maybe can impact their incentives, but also their way of operation.
But do you also report on these things, the soft things, to management?
So you mean in the auditor's report?
Yeah.
So no, in the auditor's report, we only opine on the entire financial statement, so not on those specific elements. So I think if you go to the US, they have this SOX environment where it is now more, I think, still on the direct controls, right? The hard controls, the reconciliation controls, those kind of stuff. I've done a lot of PCB engagement, so I have been in that control environment. I think I would encourage almost, let's say, kind of development to also build in the softer elements, which we have which we call indirect controls, but sometimes a little bit more difficult to assess, because how can I say as an auditor your culture is right or is wrong? There is no, let's say, binary answer to that. So that makes what the topic is always so difficult. But to answer your question, we don't really report on that specifically, no.
I saw a question.
SOX is about internal controls of financial reporting, isn't
it? Yes,
yeah, right.
Yes.
That is a question.
Yes. I had a question to you, Claudia, because I was wondering about myopic behaviors. I think that's a very interesting topic. But a lot of times I think myopic behaviors are really associated with certainty. Because as an organization, of course, a lot of big organizations have a lot of employees, so they have a lot of responsibility to be viable. And I think that when you look at those myopic behaviors, often the reason is that, well, if we do this investment right away, we see results next week, is easier than if we do this, we will see results in 2 years. And, well, will we still be viable in 2 years? So how do you think you can advise management to deal with that? Because it's a hard topic.
I agree with you, and I mean, of course, I don't have an answer in terms of what kind of advice. What I can tell you is from a practical point of view, of course, let's say investing and doing investments that they are value creating in the long term is something that companies should do. So when it comes to the myopic component, is really what is abnormal. But in terms of you abnormally cut mainly expenses, so you don't do certain investment, let's say in R&D, which again could be potentially beneficial in the future, and you do that because you want to boost the short-term financial performance. So it doesn't mean that the company doesn't have to invest at all. It means that it just, or that the company does not invest, but that's normal part of the business because just decides to stagger over time the investments for whatever reason, is just doing something that doesn't seem to be consistent with the business model or with the needs of the company, given the market, given the competition. So that is more like, there's no, I would say there's no right or wrong answer in that. And that's why it's also hard for the auditors, in a sense, to detect certain types of myopic behavior, because someone can claim that's a discretionary choice, and you cannot, as an auditor, come to me and say, you cannot do that, right? Because I say, well, you can tell me that I should invest more in R&D, but I disagree with you, and then it's really a business model of the company. Then it's a little bit hard. But when it comes to really the measuring the myopia, there are a lot of proxies, but let's say at least among the most common is the portion of behavior, let me just put it that way, that is not explained by the normal business of the company. So what deviates from what you would expect based on the fundamentals of the company or circumstances that are in place at the moment. I don't know if that addresses the
Do you have maybe an example of that?
I mean, I wouldn't go that far because that would go technicality of the measurement per se, but let's say based on company sales, on company's fixed investment, you would expect a certain amount of investment. And then you see running a statistical model that component is too small, right? Then you label that or you classify that as underinvestment, right? And that is one way, for example. And that is more like from a real point of view, but there are also, and that might be more in the interest, let's say, of the auditors, like these kind of accrual things, right? So you postpone and then some things are within the boundaries of what the GAAP allows, some are beyond. And then, of course, you end up in fraudulent cases or something that,
To that? Because a company in recession in 2008 said we want to invest at least this much, let's say 2% of sales in marketing and at least 2% of sales in IT. Because they knew that if they would make those investments, then it would be good for the profit in the short term, but not, it would hurt the long term. So that was, looking at the long term and making sure that people were making those investments. Yeah,
and right now, obviously, we like all sectors are moving and need to make big steps, quick steps in ESG transitions and whatever is most relevant for their sector. What could be interesting signs for auditors to look at then? Because this is, if you look back at the financial crash in 2008, this was a clear sign that they were doing something positive. What should they be looking at today? It's a hard question.
It's a hard question, but companies usually tend to start measuring what is easy to measure, which is already available. And we have a CFO in our curatorium, and he said, I was approached once by NGOs and saying you should provide this information. And he said, I don't want to give that information. Not because it's not relevant, but it's relevant for our company. It's irrelevant for our company. It's relevant for our customers. So I make the investments to make sure that my customers can achieve certain things which are much more relevant than if I achieve this. So I said to these NGOs, I don't make that information available because it takes me too much time to gather the information. Mm-hmm. So in that sense, start from what actually is your business model, what is your strategy, what are you trying to achieve? Start measuring the things that are really relevant, and I think the ESG regulation already indicates that you should do that. You shouldn't measure everything, but then also stick to and try to explain why those are the relevant measures and why you, for example, if you are I'm not sure, but let's say a supermarket or a bank, then maybe gas house emissions are not that relevant, but maybe savings in food or better employee circumstances are much more relevant. But then you should link those measures to your strategy, and you should be able to explain what your strategy is and why those measures are important and other ones are ignored.
Yeah. Well then, Marnix, earlier you said, as auditors we cannot really give a comment about the strategy. But it is very important for these kind of long-term ambitions of companies, also with respect maybe for long-term going concern issues, to have to address it at least.
Yep. No, so I agree on that part. So I think so what the most important thing that auditors need to do is that they have to understand the business, they have to understand the strategy, and then how that ultimately translates into their reporting. And those needs to be consistent. So I think that the auditors have a very important role in making sure and also pushing companies and the supervisory board, who are the oversight of management, pushing them to really make sure that they are measuring what they're telling that they want to achieve, and that they ultimately report on that. So I think it's very important that we keep in mind that the companies are responsible themselves for first taking into account what they want to measure and report on that and align that with their stakeholders. So it is my belief is that if their stakeholders want to have a certain kind of metric to be reported on, like the NGO in your example, Frank, I think that a company has to make the decision themselves, and I would say that the supervisory board has a very important role in pushing the company to making sure that they report on that. And then it's us as auditors to make sure that we understand their business, how that's been translated into incentives, and how that is affecting the financial and non-financial information on which we will give an opinion. Just to make sure that we understand where there are potential risks of them, reporting something that they say they do but they don't, which is ultimately going to jeopardize the business model and ultimately the going concern in the longer run.
Just raise a question in this respect. Because people from outside Europe probably not aware what we have now, and there will be a lot of regulation and standardization on reporting on non-financial, the CSRD. My question is, do we still then have this discussion with clients, etc., or do we have this is just the regulation, this is what you have to follow, and we will sign off if you will check, of course, that's it. Is the problem not solved yet already? Because the unmeasurable, that's being concretized by standard setting.
Well, if you ask me in general, I think that the discussion has started relatively late. I think that is also following the slow movement in regulation, so to say. So I think the CSRD is only approved very recently. So and companies are still wondering how they have to implement CSRD, how they have to do the materiality assessment. So I think that the discussion in general is starting relatively late, if you would ask me personally. So that means that, and that's where we are busy with today. So the CSRD is not required today, but for listed companies next year. So what I see in practice is that we are pushing our clients very, very hard to make themselves ready to report on that next year. But like everything that you're doing for the first time, it's going to be a challenge. I've never seen someone doing something for the first time that was a walk in the park. So, but yeah, it is going to be.
Wait, may I just then ask you both? Are the auditors well positioned to do this work? Or Frank will CFOs do this themselves?
You go first.
I have my doubts in a sense that it depends also on how much assurance you want to give.
We start with limited level of assurance.
Yeah, I think that I think if you already arrange for that, you can be quite happy, I would say. Yeah. In a sense that there are so many. Again, what I hear from companies, there are so many assumptions underlying that. So then the question is, you can check the assumptions, but I'm not sure whether you can check the validity of the assumption, so to say. And I think that's going to be the very difficult. So, for example, if you use customer surveys or employee surveys, let's say customer surveys, let's say that you try to rely on them in your company, but then at one point in time it's sort of hacked by a hacker group or something, and they go all the way, and you say, I'm going to ignore that and not report it. Can you do that? Yeah, I'm not sure. I think you can only say if it's limited assurance. Again, I'm not being an auditor. It's safer for the limited assurance, and I'm not sure how far you can go.
Well, it's quite interesting because if it's not the auditor, who is it? Who is the person to do it?
I think there should be an auditor, but I'm not sure whether it should be
a financial auditor.
A financial auditor doing the audit. Yeah. I think you need more expertise in order to
specialist.
Yeah.
I mean, actually, just on a side note, I think that in terms of research, we are waiting for the implementation of the directive in practice, because then we can look at the what are the consequences of that? So now the very recent research looks at the voluntary adopters, so the ones that have decided beforehand. I don't know how many, maybe you have seen none of them, because they're taking quite a bit of time. But then again, it will be a question, is this effective? Does it achieve the objective? And I think it will be very challenging to measure the outcome or the output, like depending on how you label that. But it's it will be interesting maybe in 1 year to talk again about that and see where we are given the implementation, at least for big companies.
Thank you. Do you mind if I raise the final question
Yes.
to the audience? There are some practitioners there. Are you willing to
There's
issue limited
there's one question here.
limited level of assurance? Oh, Ralph can answer this question. Are you willing to provide limited level of assurance with your own financial auditing?
Yeah, basically, the question was also, is the auditor now the required resource to give this service? But if you think about that, and you think also about the connectivity between all the commitments that the company is making, and let's say the financial statements, how does it factor in, for instance, going concern? How does it factor in all the impairments that we have to make, the tests? How does it factor in the residual value of all these, let's say, polluting assets that you have? So there are so much connectivity issues there also that I think, given also what Marnix said about the fact that we are already hiring so many, let's say, non-auditors to at least have this deugdelijke grondslag, this convincing line of why we can put this limited assurance in our reports. I cannot think about another, let's say, assurance provider there. So I believe we should trust that those firms that audit the financial statements has to, let's say, integrate this, like our clients also has to integrate this whole, let's say, internal control system in their reporting, in the hope that in the end it will come to an integrated, let's say, ESG company really looking at the long-term focus. So it is not because I'm an auditor myself and I'm working as an auditor firm, but I think from a contracting perspective, especially due to connectivity, this is a normal way to do. Yeah.
Connectivity. But it also means that you probably have non-financial auditors in your auditing. Okay. Thanks.
Claudia wants
just
No, I'm so sorry because
that's fine.
it's
It's okay.
okay. Just a word. Yes.
No, just because I think, again, it goes back to the point that was raised before. Is this really something that both big and small audit firms are ready for, like to the same extent? And I think that is, it's something I'm not sure about. So I completely agree with your point, but I also think there's a lot of variation that needs to be taken into account, because otherwise you might cannibalize part of your business just because you cannot provide both services. So it's,
Right.
yeah.
Very good. Is it someone from a smaller audit firm that does have some experiences or preparing themselves? Not in the room. Or maybe no one. Okay. Anyway, because I agree with that. I think it will be more difficult for smaller firms just because of this multidisciplinary approach you probably need. Yeah. Thanks very much. Okay. Thanks very much. Yeah. I was just wondering when I sit here, I was some economist here thinking of Milton Friedman in the 80s, who said, "No way." He said, "We are there. The management is there. The board is there for the shareholder." And don't bother management with all this kind of non-financial issues that should be dealt with by some other people. And I think he just referred to the law or to the judge who should have a say in that. But we are now in this decade, in this era, and it's very important to survive as a company anyway. So it's emerging, and I think from an academic, but for sure from an auditor's perspective, this is one of the top 3 issues that will be discussed and researched in coming year for sure. Thanks very much.
Thank you.
Thank you.
Stay there for a moment. Because I want to be sure everybody can see that I hand over. Thanks very much.
Thank you.
Dankjewel. Yeah. So if you want to take a bottle of water, You're not allowed, of course, to leave the room, but for a bottle of water, please do, because we won't have any further breaks. So I can imagine that you want some water. Please, please take as much as you want. So we'll move on to the next plenary session. Let's see if we... I lost the mic.
You lost your mic. They have mic.
Oh, you're already here.
I'm not sure whether it's working, but we have it.
Who? Yeah, you can take your jacket off if you want to, because it's warm again. The sun starts, it's probably a flat roof here. So once again, if you want water, and even during sessions, if you need something to drink, please do. So we are in the next, what I said, next plenary session. It's number 5, and the title is Internal Control Quality, Audit Team Composition, and Audit Quality. And it's being presented by Nina Schwaiger and Sebastian Kuhn, both from University of Munich. And Nina, sitting here, happy to see you here. Nina.
Thank you.
Has a PhD in business administration and is assistant professor at the LMU, that's the University of Munich. It's the Munich School of Management. And you have a research interest in target setting, internal governance mechanisms, and corporate disclosure. And Sebastian, I found that you're a research assistant, PhD student at the same university. And let's see where Yorick is. As a discussant, Yorick is sitting here. He's audit senior and audit quality specialist at KPMG, the Netherlands, and you'll be the discussant. Looking forward. And let's start then with the presentation. And come here. I still have the busy seasons box that works as well. Use this mic and mic. Very good.
Use this one.
Click on success, and I think here is a yes, sure. Here. I think if you push the button, go to the next one. Yeah.
Okay, so thanks a lot for the kind introduction, and thanks a lot, first of all, to FAR for setting up this amazing conference aiming at connecting academics and practitioners. I mean, this is amazing. And thanks a lot we are really thankful for the opportunity to present our work today. The paper, or I don't have to say paper because it's just very early work, it's just a project. So the project we are going to present today is entitled Internal Control Quality, Audit Composition, and Audit Quality. And before we jump into that project, I'd like to just very quickly introduce our team that is working on this overall FAR project. Thank you. Now it's working. First of all, to the left, you see Christian Hofmann. He's part of our research team. Unfortunately, he was not able to attend the FAR conference this year. Then next to me is Sebastian Kuhn. He's working as a PhD student on that FAR project. And then we have Jeroen van Raak in the audience, who is also luckily today in the audience as well. So Christian, Sebastian, and I, we are from a management accounting perspective. So we look at that question from a management accounting perspective. And Jeroen is luckily joined us as an audit researcher in that project. Okay, so first of all, before we jump into today's presentation, I'd like to very quickly give you an overview on what this overall FAR project is actually about. And I'd like to talk about the 2 research questions we are investigating in this project. And first of all, the first one that we present here is the one we are actually talking about today, Sebastian and I. Because we want to talk about this one because this is done based on FAR data. So we have archival data that's different compared to the previous panel sessions. We have archival data from audit firms, so the big audit firm, 4 audit firms. And we are investigating the question, what is the impact of internal control risk on audit effort and audit quality? So that's our general research question we want to talk about today. As you have already heard, we don't have a paper yet, so this is also going to be a challenge for Yorick, I guess, to discuss that. But nevertheless, we are really happy to get very early feedback on that. And that's also the reason why I'd quickly like to mention the second research question we have in this project, because here we have already tangible output, namely a working paper. And the second question we are investigating in this overall FAR project is, do financial analysts provide information on fraud risk to auditors through questioning during earnings conference calls? So the idea is that that financial analysts work as an external corporate governance mechanism and work as information intermediaries in the market, and likely therefore also have very relevant information about fraud risk that is likely helpful also to auditors to assess that. Before we jump into today's presentation, therefore, let me spend one more slide on the second research question. And as I said, this has entered into a working paper with the title Using Earnings Conference Calls Discussions to Assess Internal Control Quality. And what we do in this project is we develop a textual analysis tool. So basically, we run an unsupervised learning algorithm, a topic modeling approach, and indeed find that interactions between financial analysts and managers during earnings conference calls are predictive of internal control quality. And they are predicted of that beyond determinants identified by previous literature. So indeed, there seem to be important information in these interactions between financial analysts and managers that maybe then also be helpful to auditors, what we also investigate in that study. So as I mentioned, this is not the topic of today because this is based on US data and therefore publicly available data. But nevertheless, in case you are interested, just feel free to look at the working paper. And with that, I'd like to jump into today's presentation and the structure of that. First of all, we are talking about the research question. Then I will just very quickly guide you through the theoretical framework we have in mind that is helpful in structuring our thoughts. And then I talk about the data we have already received and the analysis we conduct so far. And then I will hand over to my colleague Sebastian, and he will guide you through the first findings we have and talk about contributions for academia and practice, hopefully. So what is the more specific research question we are investigating here? So the question we are interested in is, how do audit firms adjust their audit production process as a function of client firms' risks? So the risk assessment on of the client. We think that this question is very relevant, not only for academics, but likely also practitioners. So hopefully this research will result in implications about optimal staffing decisions in response to risk assessment. So how should audit teams be optimally staffed if there's a higher control risk in that engagement? Of course, we think that this research question is also extremely interested from an academic perspective, because usually the problem we have as researchers looking at that from an outside perspective is that we only have very noisy and broad measures of audit quality. So what the literature usually does is they're making use of audit fees as a measure of audit effort. But of course, this not only includes audit effort, but also risk premium. So therefore, we are in a lucky position, thanks to FAR and the auditing firms behind that, we are in a lucky position of having access to a much more detailed data set, which allows us then to capture audit team composition. And we are looking at that from using a conceptual framework that is pretty established here, namely the audit risk model. And the idea of this audit risk model, I guess you all know that, it's just to make sure that we are all on the same page. The idea of that model is that auditors have to hold audit risk constant, and thereby audit risk comprises the three elements: inherent risk, control risk, and detection risk. Together, inherent risk and control risk form the risk of material misstatement, and it's the task of the auditor to make sure that they provide enough audit effort into that engagement such that audit risk is held constant. What do we actually... Okay, now it's working, I think. Good. So let's maybe quickly think about, or let's talk about what we actually already know from previous literature. And here we already know that the first link is there. So there is a link between risk assessment and audit effort. So what we find from previous literature is that audit fees indeed increase with low internal controls, which gives us some indirect evidence that audit effort increases if there's a higher control risk at the client side. There's a more recent study that was able to disentangle audit effort and risk premium, and they indeed find that not only audit effort increase, but also the risk premium increase in response to higher control risk. In terms of the second link, we also know that audit effort translates into audit quality. So there are a couple of studies looking at audit fees as a measure of audit effort and show that this is positively associated with audit quality. And finally, there are a couple of studies, I'd like to just mention this one here, that look at the whole triangle and are indeed able to show that the audit risk model works in practice. So auditors increase their audit risk in response to a higher control risk, which then in turn translates into higher audit quality. So this is actually what we already know from previous literature. How do we now want to elaborate upon that and extend that idea? We do that by arguing that the audit effort is not provided by one party, but it's provided by a team, right? So therefore, it's important to understand to what extent each team member puts effort into that engagement and how this overall team effort then is constructed. So looking at that picture, the idea that we have in mind is we want to understand how each individual team member puts effort into that engagement and how this overall then drives audit effort and is then dependent on the risk assessment of the client, specifically the control risk. There's some formal framework that the literature has come up with rather early. So it's a study from 1994, so pretty old, but nevertheless I think gives a nice formalization of the idea we have in mind. Namely, it's describing the incentives of an audit firm. And the idea is that the audit firm is of course interested in minimizing the cost of that audit process. And the costs are determined by two input parameters. That is, on the one hand, the audit effort that the team members put into that engagement. And in addition, it's the client characteristics that drive that. And they are, of course, exogenous to the audit firm. So the idea is that the auditors want to minimize the cost of the audit. But of course, they are subject to a constraint. Namely, they have to make sure that they hold audit quality at a certain level. Prior literature has shown that client characteristics matter then for the nature and mix of input factors. So that's basically then the task that the auditors have to decide about which kind of effort they put into that engagement in order to achieve low cost by at the same time holding quality at a certain level. And prior literature has shown that client characteristics such as complexity, inherent risk matter for the nature and mix of resources. However, what is not clear is to what extent control risk matters. So to what extent does control risk drive the nature and mix of input factors? And that is indeed the question we are investigating or plan to investigate in this project. Namely, how does control risk determine the nature and mix of input factors in the production process? So now the question is, what do we mean by nature and mix of input factors? And let's be a little bit more specific and do some brainstorming here on that slide. So to what extent do we expect differences across audit teams in terms of input? So we could think of teams differ in terms of size. So some teams are larger than the others, and this might be one way to address an increased control risk. Another way of doing that is just changing the composition of that team. So do I use in that engagement more experienced team members, so those that have experience with the client? Do I use more higher ranking people in that engagement? Or do I use, for instance, people that, do I use a team that is more diverse? So we talked about that in a previous discussion. Is it important to have a diverse team to address that increase in control risk? And all these things we have in mind when talking about the nature and mix of input factors. And we think that it's extremely interesting and important to understand what auditors can do in these dimensions in order to address this increased control risk. How do we now investigate that research question empirically? So we have already access to data from 2 out of 4 Big 4 audit firms. And the data set covers here 2017 to 2019. And it covers all listed client firms and the largest unlisted client firms in the Netherlands. And we exclude hereby the holding firms, the financial institutions, and the governmental organizations. And this gives us, for the moment, a data set of 430 engagement observations. before I show you how we now investigate this kind of data to investigate that research question, let me just briefly summarize the main advantage of the data we actually have. So luckily, due to the access to that data, we have much more precise measures of audit effort and also audit risk premium. Because as I said, publicly available data, if researchers use that, they typically rely on audit fees. We have information on actual audit hours and budgeted audit hours, which gives us, of course, much more precise measures of audit effort. So by simply using the actual audit hours, this is a great way of capturing that. And in addition, by comparing budgeted and actual, we have kind of a measure of spontaneous adjustments in the audit process in terms of hours. And we have information on audit risk premia, so we have audit fees per hour as a measure of that. And finally, we luckily have access to audit team composition data, so we actually know the rank, tenure, and workload of each audit team member. And previous literature did not have access to that or had to rely on survey data instead of archival data. Let me then show how the analysis look like we actually do. So we investigate the audit risk model, which includes these two links, the link between internal control quality and audit effort, and then audit effort and audit quality. And this is indeed what we are looking at here by running these regression specifications. Let me just talk about the measures we use to try to capture those underlying contracts. First of all, internal control quality, how do we capture that? So for the moment, we simply count the internal control deficiencies in that engagement as a measure of internal control quality. We have much more detailed data on that, but just did not have the time yet to investigate that further. And we measure audit effort by looking at the actual audit hours and then the ratio between the actual audit hours and the budgeted audit hours. So as a measure of overtime in our case. Audit quality, I guess you all know that this is pretty hard to measure. And for the moment, we use the literature measures, so measures that were used in previous literature, such as the Kuhn models that were also discussed in a previous discussion. We use audit fee measures, we use the misstatement information, so the number and the value of misstatements, and we're happy to hear your thoughts on additional ideas, what we can do using that data set we have. With that, I hand over to my colleague Sebastian, who will guide you through descriptive evidence and then regression analyses.
Thank you, Nina. Yeah, as we said, we have a really nice sample of data from Pouw already, from these 430 engagements. And before we jump into the results of the regression analyses, I would just like to talk about what this data actually looks like. And for the first part, I would like to talk about the audit teams that we have that actually drive these engagements. And what we see here in the data is that the average team in this sample has 19 auditors. That is the number of personnel who do any amount of work, not just the core team, but in total. And that is comprised of 2 partners, 2 directors, 4 managers, 11 staff, and 2 trainees, again, on average. And we know that that adds up to more than 19. That's just the rounding errors adding up. Also, something we found interesting is that on average, over half of auditors are new to a client for any given year. So we see that there's quite a bit of movement here from year to year on the engagement teams. We also looked at how these auditors, or how this audit personnel does work on any given engagement. That is, how many hours do they put in. And you can here see the proportions of any given rank in terms of audit hours. And as you can see, the staff that makes up most of the team also does most of the work. Then you have fairly proportional work from the managers and the directors. The partners do a little bit more work compared to their proportion of number in the team, and the trainees do comparatively little work. So that is what the audit engagement teams put in terms of hours. Now let's add some descriptive statistics about what they do in terms of the audit of internal controls. And here, first of all, just to give you an idea what we're looking at here in terms of data, the average engagement has 3 significant deficiencies in internal control, and that varies greatly between engagements. So we have some engagements in the sample with absolutely 0 significant ICDs, and others with up to 34. And in total, around 66%, so 2/3 of engagements have at least 1 significant internal control deficiency. And out of these ICDs in the entire sample, around 10% affect revenue, which is just some illumination what kind of data we're looking at here. And finally, again, looking at the audit effort measure. Sorry about me holding the microphone here. So what we find is the actual hours of any engagement team on average are 23% higher than the planned audit hours ex ante before the engagement. And we also find that this overtime, as we call it, measure, it's not really overtime, that is correlated positively with the average rank within the team, which kind of indicates that higher ranking auditors do a higher part or a larger percentage of this unplanned audit effort. And it's also negatively correlated with firm profitability. So this suggests that profitable firms are a bit easier to audit and definitely less risky to audit. So those are a couple of descriptives, just to give you some idea what kind of data we're working with here. So let's jump into the results of the regression analysis. Yeah.
So what is that exactly, right? Is it something that you can circumvent in your audit, right? Or is it something that is severe, right? What is a significant ICD?
So the significance, this is just the decision of the audit team that is marked as significant or not. We haven't really gotten into the nature of what type of deficiency is marked as significant or not. Definitely something we want to do, because we have a lot of really nice data on the description, how it was found, what it affects, financial statement lines that are affected. And it's really something we are burning to do, but yeah, unfortunately for today it was a little bit early. Okay, so for the first regression that we have here, that is the first part, this first link in the audit risk model, so the relation between internal control quality and audit effort. And as Nina said, we have two different ways to measure audit effort here. And the first is just the number of audit hours, that is the natural logarithm of the hours of the entire engagement team. And as we see, there's a significant positive association between the number of internal control deficiencies found during the audit and the hours worked during the same audit. Now, of course, we know that that's not necessarily picking up the relation that we are interested in, because it might just be that teams that work more hours just find more internal control deficiencies, or that these teams already plan to do more work because they know that the risk of finding an ICD is higher. So that is why we think it's quite important to have a look at the second specification, where again we look at overtime defined as actual engagement hours divided by planned hours ex ante. And here we also find a positive relationship. This is only significant on a one-tailed 10% level, but we think that is somewhat acceptable here because we have, based on the audit risk model, a very clear directional hypothesis. So how do we interpret these two, or the results of these two regression models? Well, this is additional evidence based on this very granular FAR data that the audit risk model, that this part of the audit risk model works in practice. That is, auditors encounter significant deficiencies in internal control during the audit process, and then as a reaction increase their effort. But as Nina already mentioned, this is what previous literature has done, and this is definitely interesting, but it doesn't tell the entire story. We don't know how this audit effort is actually produced, and that is something we are more interested in and that we look at next. So to do this, we define 4 different variables or 4 different constructs that try to capture some dimensions of the audit effort of an engagement team. The first one is the team size. So again, just the number of personnel who work on an audit engagement. And here the idea is you could, of course, increase audit effort by adding more people, adding more auditors to an engagement as a reaction to finding internal control deficiencies. Then, quite the opposite of that, we look at, okay, I'm jumping ahead of myself, would be the hours per auditor. So if I'm not adding any additional auditors here, then I might just increase the workload for the team that I already have. Now, squeezed here in between is the average rank of the personnel, weighted by the hours that they spent on any given engagement. So it might just be that basically the higher ranking people pull more weight as a reaction. And finally, somewhat related to the two before that, we have the standard deviation of the hours in the engagement between different personnel. So that is, does everybody on the engagement do the same amount of work, or do some people just do way more work than everybody else and just react to internal control risk that way? And we find we think this is some really interesting preliminary results, and we're really looking forward to hearing your thoughts on this. So first of all, we don't find a significant coefficient for team size. So no significant relation between the number of internal control deficiencies and team size, just not necessarily what we were expecting to find. We do find, and this makes sense then in combination with the first result, that the hours per auditor do go up. And as a side note on the number, on the coefficient here, the data that we get from FAR is transformed. So that's not a real number, and we don't expect an auditor to work an additional 180,000 hours. That's probably a good thing as well. But yeah, the hours per auditor go up on average. So these two results in combination, they suggest that you don't get additional personnel in, but the workload is increased for the existing team. The other two results are also significantly positive. For the average rank, again, not necessarily an intuitive result. I'm really looking forward to hearing everybody's thoughts on this. But this suggests that when you have internal control deficiencies, that the higher ranking people in the team, they do more work. And finally, the standard deviation increases as well. And this is, again, this fits very well with the previous result. That means some people do a lot more of the work, and it's not that everybody does the same amount of overtime. Yeah, these are our results for this second set of analyses on the audit effort production. And finally, we bring it all together and have a look at the effect on audit quality, because that's what the foundation is all about, audit quality. And here, as Nina said, we have the same problem as basically everybody. Audit quality is just really difficult to measure. And we try to increase the validity or ensure some validity by just using a couple of different approaches and seeing what that looks like. And here we find in the first two columns for these two accrual measures, basically we find the results that we would have expected based on the audit risk model. That is when the hours overtime, or that is engagement hours divided by planned hours, when this overtime is higher in the presence of an internal control deficiency, then these accrual measures are significantly lower, which we can interpret as this additional effort. Well, we can't say as a result of an internal control deficiency, but that is how we interpret it. This additional effort does increase audit quality. Results are a little bit less clear for the audit fees measure. The idea here is when we control for things like engagement risk and all these fundamentals, then additional audit fees would be a measure of audit risk, and that is the inverse of audit quality here for us. And we do not find a significant coefficient. The coefficients do have the signs that we expected them to have, but they're not significant. And things are also a bit unclear for the two misstatement specifications. Again, here the idea is when we control for all the other risk factors, then finding more misstatements we view as basically a good thing, higher audit quality. But for the first one, that is just the number of misstatements, we find a positive coefficient. That is, this additional audit effort in the presence of ICDs is positively correlated with misstatements, but it's not significant. And for the dollar amount of misstatements, we actually find a negative and significant coefficient, not in line with what we expected. And yes, please.
Yeah, just to understand it, the number of observations differs.
Yes.
What is the explanation for that?
That is a very good question. So we do have some missings depending on how we exactly specify the regression models. It's a bit unfortunate. It depends on the inputs that we need, for example, for the two accrual measures. There's just a couple of things that we put in there, and sometimes observations get dropped as a result of that.
Other question, what do you mean with misstatements, just to prevent that our US colleagues will be confused?
Okay, that is the misstatements found by the auditor. Yeah,
so
that is
enforcement by.
Yes. Okay, that's probably a very important point. That is, again, we view this as a good thing. Basically, the auditor finds more things that the client did wrong, and when we control for the ex ante risk and for all of that, then that means that the auditor probably did a good job. Yeah, good point. Yeah, I think I said all of this already. So it's a bit of a mixed bag that we have here. So how do we interpret what I just showed you? So for the first part of our research question, or the first part of the audit risk model, what we find is some confirmatory evidence that audit teams, audit engagement teams do increase their effort when they are confronted with internal control deficiencies during the audit of internal controls. And we also find how this audit effort is produced, and that is by increasing the workload per auditor and not by increasing team size. And we also find that the workload is not equally distributed, but a couple of people per team basically do more of the work, and that is in line with the idea that it's the higher ranking people who really do that additional work. For the second part of the audit risk model, the effect on audit quality, we find, again, a bit of a mixed bag situation. The results and their significance and how they relate to our ex-ante expectations are dependent on the model specification. When we look at the accrual measures, then we can make a fairly clear statement, and as a guideline we can say that when the planned audit hours are around 15% higher than the actual audit hours are around 15% higher than the planned audit hours, then according to this model, the overall level of discretionary accrual is kept constant in the presence of internal control deficiencies. Of course, I think we've mentioned this a couple of times now, we do have some limitations for the study, should be fairly obvious. We do not have a perfect measure of audit quality, if such a measure even exists. I'm happy to hear about it. We also have a fairly limited sample size at this moment. We're very happy with the data that we have. It's really high quality data, but we are also looking forward to getting just an increase in sample size, because obviously the statistical power of our models in the moment is it's not quite there yet. In addition to an increase in sample size, we have some other ideas what we want to do in the next steps. And this is basically just going further and more in detail on the questions that we have tried to answer so far. So we have analyzed internal control quality by just looking at the number of internal control deficiencies. And I think, Jan, this relates back to your point earlier. Obviously, there's a huge span what constitutes an internal control deficiency, and we do have great data on that. And we want to just analyze the nature and the severity of these internal control deficiencies, what they affect within the firm, how they were found during the audit. And our current treatment of that is not, basically doesn't take all of that into account. We also want to go more into depth on the audit team composition. This is something that we find really interesting. We have some great data here, and we want to know how the characteristics of the single auditors and then of the entire auditor team, how these affect the audit team's ability to audit the internal control systems and to basically hold audit risk constant in the presence of internal control deficiencies. And as Nina already mentioned, one measure that we're really interested in, or one concept that we're really interested in, is team diversity. I think or other people have talked about this today and yesterday. We've had this idea, we want some creative types, some social types, maybe some tech-savvy types, some type of tech nerd. So we don't want 5 or 10 auditors in the team and they're all the same person. So this idea of team diversity, we think is really promising.
How would that fit in your model? What would that explain? Audit quality, or how does it link to internal control deficiencies?
We are not 100% sure. That's why we didn't present anything on that yet. But yeah, it's just something that basically interests us in the moment, and we really hope to maybe come back next year and tell you what we found. Okay. Of course, the idea of the foundation is that we contribute to academic knowledge as well as to practitioners. And we would like to start with the contribution to academic knowledge. Here we basically expand on all the research that has already been done on the audit risk model, and that was mainly forced to use these rough proxies of things like audit effort because they were using public US data. And we have much more detailed data and can mostly confirm the results of these prior studies. That is, we have some preliminary evidence that the audit risk model does work. And we also add some evidence how the audit effort within that model is produced, and that team composition and team effort are a bit more multidimensional than previous literature treats it as. The FAR data here, in case that hasn't been made clear enough already, the data that we got from FAR has been 100% crucial for this project and for how we have been able to conduct it. So without this detailed data, we wouldn't have been able to do this at all. So I'd also like to say thank you to the foundation and also to the FAR liaisons at the audit firms for their great and hard work. And speaking of the audit firms, of course, we are hopeful that we can also contribute to their work and maybe gain some insights for them as well. And here again, our evidence is the audit risk model currently does work in practice, which is probably good news. And using these accrual-based measures of audit quality, we can also give this rough guideline that when audit hours are 15% above planned hours, then that will keep discretionary accruals constant when internal control deficiencies are present during the audit. And we hope to add more insights for our practitioners in the next steps when we look at staffing decisions in more detail. And that brings us to our final step, or the final question: what can we as researchers do with this data and with this research question to help practitioners more? And I think this is really something that all of you are better at answering than I am. So what we're interested in is knowing, are there criteria that are relevant when staffing engagement that are particularly relevant here, or that we are missing, or that would be very promising? And the same goes for the extent that staffing decisions affect audit quality, especially in the presence of internal control risk. So yeah, we are really looking forward to the discussion and all of your ideas. Thank you. That's it from us.
Thanks, Nina and Sebastian. Very well, and thanks for the good news. What you said. Yorick.
Yeah, so, sure, thank you.
Do you need the slides or not?
I have one little extra slide, but I'll get to, yeah. So, the challenge that I sort of got from this is the fact that it's preliminary research, and that there's also a large question for you in particular with regards to how this data can be used and what kind of things you would like to see. The questions were already. Well, actually, can I go back to the? Wait. Can I go back to the? Okay. There were also some questions from the researchers themselves on how the data can be used and how, especially with regards to team composition and also with regards to guidelines with budgeting hours. The other thing that it brings up is, of course, workload for team members and whether or not that provides clear insight. The current results show an outsized input from higher ranking members. Also, that generally the response is not to include more team members. In my discussion already with the researchers, that was also probably due to the fact that it's not. There are significant constraints regarding the ability to add team members, and therefore you get increased audit hours. And so this also then puts pressure on teams, even though they are clearly responding to internal control deficiencies with increased audit hours, increased audit effort. There's a tension there with regards to whether you really want to find internal control deficiencies if you already know that it's going to lead to a lot more effort. I have, before I get to my questions, these are more sort of additional things that I'd like to talk about in case we would like to dive a little bit further into the research. I would first like to open the floor to people and both on the side of what questions do you still have about this research, what's still unclear, as well as what would you like this data to be used for and what kind of characteristics or guidelines would you like to know more about? Go ahead.
Thank you very much. Perhaps just a further consideration, and you've already alluded to it, Yorick, where in, I think early last year, the FRC engaged a third party to run some focus groups across the 7 tier 1 firms in the UK. And one of the specific things that they found was that team members are more resistant to actually raise problems that they find because they are under pressure regarding workload. So the relationship between having found deficiencies, perhaps with extra audit hours, I think you mentioned you don't know which one comes first, the chicken or the egg. Was it because they were more, did they raise the effort because they found more, or did they find more because they raised the audit effort? So in this case where team members are already under pressure, and we know that time is one of from the culture surveys that's been performed throughout the firms, time is one of the biggest constraints. How do we propose to resolve that hesitance that is totally natural from a human behavior point of view, to not want to increase your workload already, that's already stretched, and how that impacts directly on audit quality?
Yeah, so I'd like to ask the practitioners, especially also in the room, what they are thinking about this, because we can come at this from a couple of different angles. You can come at this from the sort of the culture angle, but of course also we have the researchers here available. Maybe it leads to a question that they can then also research. So both perspectives are good. Does anybody have any ideas regarding dealing with the incentives to produce internal control deficiency or misstatements or any other findings versus the audit effort that it produces? Or have you seen this in practice? Or how do you see this happening in practice? Do you see this reluctance, or is that a realistic concern or not?
I do at least one person who is working on audit quality, so. Okay, start here. Yeah.
Yeah, I mean, I think you know, I used to be a practitioner. I don't work in audit as much as I'd like to anymore. But I think I think in terms of you know, one of those results about seeing an indirect correlation between finding internal control deficiencies, but not necessarily finding monetary differences as well. That's not surprising to me. You know, I think the reality is that when you perform an audit, as long as that planning process has been worked out fairly well, is that the internal control deficiencies that you identify tend to be fairly boring, minimal ones, like the finance director hasn't signed the invoices, for example. That doesn't often lead to a monetary issue. It just leads to more sampling work being done in the audit, which contributes to more work being done. But actually, you know, most of the internal control deficiencies that tend to be identified during fieldwork are fairly minimal, inconsequential things. And you know, so that's why I wasn't surprised by that. In terms of like the question about staffing resource, I guess since we're with academics in an ideal world, right, we'd staff and resource our audits with the right people in terms of their expertise, their knowledge, their experience, etc. The reality is what we do is we pick the person that's available to do the job on that day, and they could be a partner, or they could be a trainee, or they could be somebody in between, and that's just the reality of the resource crunch that we have in the space, and you know, that comes with its own challenges. One of the other questions I did have with the research was that trainees seem to do absolutely nothing on audits, which fascinates me because you know, I know, speaking to trainees in Big Four firms, they get flogged like absolute dogs, and you know, the fact that they're only doing 2% of the audit work, what the hell are they doing the rest of the time? Because like, that just staggers me, absolutely staggers me. So I'm not sure if the categorization in there is maybe a little bit off.
I'm going to take it step by step from what I understand. So the first thing is, I know you asked like what you had an interest in exploring the actual characteristics of the internal controls. I think that you mentioned that, oh, are they significant or not? Are they really are they boring or not? That's something that I think you could further research. I think that's definitely a topic of interest here. What was your second point before the staffing resources? Yeah, the staffing resources. I don't know if it's possible from the data to see like how at what point the staffing is included. If it's part of the planned process, and then if it changes over time, like you can see with budgeted and actual hours. Is that possible? You don't think so? Okay. Okay. Well, I mean. That would be something to consider, but I guess that's hard to research. And then the third component is help me, the trainees' effort. Could you explain that a little bit more with regards to the distribution of work with to the trainees' effort? I'm going to give you the mic also.
Okay, sure. So I mean, this is basically just what we found in the data. I agree that it's possible that there are some labeling issues also because we had to basically combine data from two different firms and they don't use the same labels. So there always might be some loss in translation there. And as a result, I wouldn't say that this is the truth, and anything else that people actually do the work, observe is now invalid. I wouldn't start giving trainees a hard time because we've shown that they don't do any work. Far from that.
What do you mean by labeling issues, like preparing versus reviewing, or how should I see that?
Just basically also labeling the job descriptions from the
Yeah.
persons, also what they do in the engagement, and sometimes that's not 100% easy for us to track what role they have and at what stage they are and something like that.
Okay. Yorick? Yeah.
Are our master students that we give them the opportunity to engage in some audits. And so these are students from the university which we hope to hire pre-hirees doing their research, their master thesis research in our offices.
And their hours are also written.
Other, let's say, hired audit personnel are ranked staff or senior staff or manager or whatever. At least not partner, happily, but they're already ranked.
All right. There was a question here. Yeah? Do you mind, Yorick?
No, go ahead.
Okay.
No problem. Does that work? Yeah, okay. I'm not a practitioner, but I hope it's okay to ask a question as an academic. So first of all, I was wondering a bit, can you give a bit more details about the type of clients that you looked at? These seem to be very big teams. If on average there's 19 members, multiple partners, multiple directors, so a bit more context there. And then similar, in line with that, I wasn't particularly surprised that you don't find anything on team size. I think if you look at who does the work, or who's going to be planned to do the work, I think that's largely based on what we saw in prior years. And then also if you think about the timeline, so I will assign the team, at least in my theoretical ideal world, we will assign a number of people to do the work, and then we find the deficiencies and then we adjust. So I think the suggestion to actually look at people who join later on would be great to see, they actually found something, so they address it by also adding someone else. I don't know whether you have data on consultations, number of specialists within the team, so especially if there's multiple partners and directors, it seems to me that maybe some of those are specialists or the internal quality reviewer. So to exploit that a bit, to really see, okay, do they actually adjust now the effort and the review based on this? Thank you.
Thank you. Great points. I think does it work?
The mic, please.
Boom. Check the box. Yeah. Thank you. Yeah, I think you make some great points, and we also find we've tried to get to the bottom of that, and it's not perfectly easy, but I think we've made some progress. For example, with the partners, what we find is that there's two on average. One of them does way more work than the other, so that's definitely not an equal distribution. We don't have a perfect measure of what constitutes a specialist, and we are also lacking this. What we really want to look at are people brought in that weren't planned initially to also be brought in. So that's definitely one you want to look at. We know when they come in, we know how much work they do, but we don't know. And I think that also relates to your comment about team size, because again, that's not the team that basically goes the core engagement team, but this also includes people who, and we don't know how much they do, but we see that they do as a relation way less work than others. So I think that answers that question or address that comment.
The type of clients.
Maybe you want to take that one?
Time of clients?
So basically the clients that we have is everything that we got in terms of listed companies in the Netherlands, and then the largest unlisted.
That's why the teams are that large.
But again, I think the 19 is a little bit misleading, because that's not 19 people who are in the same room every day.
Secretaries are included as well?
And janitors. Yeah, no, I'm kidding.
So there was a question.
There's also lots of questions over here on this side.
So that's what we do. Just who catch you, just like
Elsa, I know you were raising your hand already.
Raise your hand, and then I will throw.
Okay.
Yeah, thanks for this interesting study. I'm Eddie Kaartenaars from Tilburg University. I was quite intrigued with this unequal workload kind of idea with the standard deviation, and I think, there's a case maybe that it is unequal. If you have problems like internal control deficiencies, you hope that the partner steps up, and that's a good maybe unequal workload, because the partner now has to show his expertise. But if all these hours go to the staff, the junior people, the increase in over hours you call it, then it's maybe not a good thing. So I was wondering, could you exploit a little bit here and maybe think about theorizing that if things get difficult, you hope that the more senior people step up, and not that all the work goes to the juniors, for example. But I don't know whether your data can speak to this.
And it's also, in what ways is the data prescriptive rather than descriptive? That's always a bit of an issue. So like, does it say anything about what you should do or what should change as well? So could you answer his question? Oh, we're using the cube.
Yeah, so basically I think that also relates to this finding that we had that the average rank is significantly higher for the engagements where there are internal control deficiencies, where we were initially surprised to find that. But if I take you correctly, then you're not that surprised, because I mean the higher ranking people basically should get assigned to do the harder tasks. I mean, I think intuitively that makes a lot of sense. I don't know if we have theory on that, and I agree that we should look into that. And we can definitely also look at how the distribution, this unequal distribution, what this means in practice, like who is actually doing more work than the other ones. Yeah, thank you.
Mark. And then we have a question over there as well. Oh, yeah.
I think I'm the first to drop it, so
No,
it's
no.
not the quarterback, it's the receiver.
No.
During the lunch. It's the it's not the quarterback, it's the receiver. So Mark from Illinois. So very interesting study. I think a couple things came to mind as you were presenting. First of all, you know, in the spirit of this conference, we're trying to learn from practitioners and researchers. It's really also important to look at different methods in your research. There's actually a lot of judgment and decision-making research that has looked at auditors' reaction to control risk. So I would really, have our, you know, if you can do behaviorally informed archival work, that would be awesome. And we need to do this too in the behavioral space. And that's not my word. I think it's Rob Bloomfield and Mark Nelson and Bob Libby came up with that. So that's a pretty good phrase. And also there has been archival work, and I'm not, this is out of my depth here, but just off the top of my mind, that has looked at auditors' responses to control risk with panel data. They so go look at some Tim Bell studies back in the early 2000s, mid-2000s with Landsman and with Solomon. So please, and you have great data, and you don't, there's not going to be an issue with contribution here in the end. I think you're going to get there. The one question I have for the authors, though, is did you look at changes in the planned budget? You have at least 2 years of data. I couldn't remember if it's 2 years or 3 years of data. But did they change the planned hours by rank or anything like that in response to finding deficiencies in the prior year?
Right, thank you.
Maybe I can take that question. Thanks a lot for the interesting ideas. Related to your last question that you have, I mean, this would be amazing, and we are working on that. We are waiting for the 2 additional data sets, and then likely we have enough power to explore adjustments. Currently we have 3 years of data, and therefore it's pretty hard to get to that adjustment idea. But nevertheless, we give it a try, and hopefully we find something, because this would help us, of course, a lot with all the indigeneity issue in there. Thanks a lot for your important question.
So
there were some more. There was a hand over
here.
here.
There's one more question.
Do you have
Maybe
time?
in between, while I'm walking, raising question,
Yeah.
and maybe it's to practitioners who are working with audit quality, because you also have the accruals kind of thing. But this is far, so you have this internal information. Are there any other audit quality indicators available within the firms? And I'm looking to people who are really in audit quality from a firm perspective, because it's strange, because it's still a surrogate. Yeah? And then I come to you. Yeah.
Of course, an audit quality indicator could be are the results of, let's say, our own internal inspections. But that would, I think, reduce the sample size too much, because we are only doing a limited internal inspections. So I think here we have a kind of constraint that not all these samples, that not all the entire sample size has been seen internally. And of course we have e-QCRs, especially because these are listed companies. But yeah, that is basically, I think, our internal measure.
Yeah, Christian Peach, Erasmus University. I was wondering, you look at these engagements in isolation in your study, right? So I'm wondering if you have this overtime due to these internal control deficiencies, especially with the higher ranked auditors, partners, senior managers, directors, they typically have a portfolio of clients, right? So do you have data on their other engagements and whether there's any spillover effect, because you find that they can hold it constant by increasing the overtime, but does that come to, the extent that it reduces audit quality maybe on other engagements?
Thank you for that extremely interesting question. We have thought about it as well. So that's the next step, that we're going to introduce also constraints in terms of capacity and therefore also look at partner portfolios. That's exactly the idea, because we have that data and it would be extremely cool to see where they put their effort into in case there's constrained capacity. Yeah, thanks a lot.
May I have a big applause, please, for the discussant and the presenters? And I know, intentionally I exceeded 10 minutes because I think that's interesting. You're still all alive, so that's fine. So starting with Yorick.
Oh, thank you.
Yorick, thanks very much.
Yes, thank you.
Thank you so much.
And I hope it will add to your paper that's going to be written now.
Yeah.
Thank you. You're still, someone wants to take a bottle of water, no problem at all, because we will now shift to the Kris. It's plenary session number 6 in your program. Kris. Yes, sure, because that's something we want to prevent any accident here. So if there's someone else who has to go to the toilet, this is the moment. There will be a queue probably. No problem.
Dat is toch even...
De meeste mensen blijven hier, dus we kunnen niet ontsnappen. Nou, wel goede discussies. Ja. Je moet wel voorzichtig zijn. Je wilt wel Schwaiger wat voorzichtig zijn.
Oh ja, precies. Ja. Zometeen als je hem gebruikt, er eventjes één keer in.
Om hem aan te krijgen?
Ja, als het lampje rood is, dan staat hij
doet hij.
Hoe marcheert deze hier voor de rest?
Nee, hij gaat zo meteen gaat hij. Dan komt het hier en dan kun je drukken. Het duurt een vertraging. Ik ga even de mensen van gang.
Ja? Ja, ik had het gezien, ja. Ik zag het ook op de website. Sorry.
All right, Kris. Yeah, I think we'll continue. All right. May I ask you to take your seats again? Because I would like to continue, and we have now a final session. And if you want to follow and understand this session, I ask you to be professional skeptical, whatever it is. Because it is about professional skepticism. It's really elaborated in the auditing standards, and it's a real interesting topic for research. And even in practice, we try to make people professional skeptical. I don't know how, no medicines or whatever, but Kris, we were happy that you were here, did some research, and I'm going to share your thoughts about this. And I have to, and I will, and I'm honored to introduce Kris. He's professor at University of Antwerp, Department of Accountancy and Finance, and current research project are auditor selection process, firm disclosure on uncertainty, and last but not least, professional skepticism, profiles and effects on audit processes and outcomes. And Kris will inform us in greater detail about his last FAR project. Kris, the floor is yours. Oh yeah, before, I'm so sorry. There's no discussant because Remco de Steege is in the program, but he is ill. So together or with you, you will be the discussants. Great, Kris.
Okay, thank you, Philip. Thank you for the introduction. I don't think there's going to be a problem to have a discussion given the topic. My template of the presentation didn't include nice opportunities to include pictures, so I don't have pictures of my entire team here, but let me nevertheless say that this is a project together with Anne van Stouwen, who's also here, and with Carla Zems and Sanne Janssens, who both are not here. It's not my latest FAR project, I have to say. As you can see on the slide, the data, or the project was funded, one of the very first of the FAR actually in 2016 already. If Justin was joking about slow science and quality yesterday, yeah, make your own conclusion, I would say. That being said, we have a lot of data eventually gathered over the years, and I'm going to discuss some of that with you today. I don't think I really have to explain why professional skepticism is important, either whether you're from academia or practice. If you doubt that skepticism is an important topic, you can just look at this booklet that we got from the conference here. It has 4 practice notes or 5 practice notes in it, and all of them except one actually deal with the topic of professional skepticism. Makes me also a little bit nervous because there's a lot of people here with knowledge about this topic, but makes it quite interesting, I think. Basically, what I'm going to talk in this presentation is what are the most important things associated with skeptical actions of auditors. And we look, and I'll ask you to think a little bit about that as well. In a second, I'll pop up a slide, and you can give your own thoughts. We look at both personal characteristics, people's personality, working experience, specific audit knowledge, industry expertise, motivation, and that sort of stuff. As well as more environmental characteristics, things that have to do with the specific client, the specific engagement, the audit firm where people are working, the culture of that firm, and so forth, and so on. All right. Like I said, I'm going to ask for a little bit of interaction here, and the slides doesn't seem to show the website that you need to log in. That's quite unfortunate. Let me see whether I can tell it like this. So if you take your cell phone and you go to Pouw, POLLEV.com / and then Kris Hardies, so that's just my name, KRIS HRDIES 317. So POLLEV.com / Kris Hardies 317. POLLEV.com / Kris Hardies 317, and then you should get on the screen 317 And then you should get on a screen where this is being shown, and you can enter whatever you think there as a response. Enter them one by one. You are allowed to give in as multiple things as you want, but do it one by one, and then they should be popping up on the screen, hopefully. Does that work actually? Because you're not logged in with my account, I assume. You're submitting stuff, but you're not seeing it. Oh, can I see it on my cell phone, maybe? Something to work on for next year's presentation, I guess. Okay, I'm gonna actually just look at my laptop so I can see the results, because I think it's quite interesting to see what you're thinking. Okay. So the question is, what do you think are the most important factors associated with auditors being more skeptical on their audit engagements? What are the factors, things like motivation, personality, audit firm culture, tone at the top, whatever you can think of? Yes, you can submit multiple things. Oh, you're submitting too many things. All right, I see a lot of things on my screen now. So indeed, you've been submitting a lot of stuff. Let me see what I see on my screen. The most important thing, or the thing that shows the biggest on my screen, is time pressure. It changes a little bit depending on what people are submitting. I see experience popping up. Culture is pretty big as well. Knowledge, somewhat smaller. Incentives is popping up as well. Personality. Awareness, expertise, status. Presentations of yesterday may have to do something with that, I guess. Being comfortable, and a couple of other things there. All right. So that gives us a little bit of an idea what you're thinking at, and feel free to jump in at any point, by the way, if you want, since that there's no discussant anyway. Let's have a look at. Let's have a look at what we have gathered of data and what our results actually show are the most important things. We did a quite extensive survey. Some of you, the practitioners here, may have actually participated in that. 663 auditors in total participated in that, across pretty much all of the firms participating in FAR. And we had a very extensive set of questions, both about the people themselves, trying to measure their personality, knowledge, experience, and so forth and so on, about the audit firm where they work, the culture of that firm, the extent to which people believe the quality control system in their firm to be strongly developed, the extent to which professional skepticism and audit quality is being taken into account in their performance evaluation systems, and these kinds of those kind of things, and a whole bunch of questions about the specific engagement, about one specific engagement. And for the academics, it might be important to know that the specific engagement they completed the survey about was not self-selected. They were assigned one specific engagement that they had to complete a survey about. So it's not a self-selected engagement, and they completed questions on that specific client engagement in terms of whether they felt budget pressure, time pressure when working on that engagement, how important they think that the client is for their firm. And then, of course, they answered a bunch of questions related to what they actually did on that engagement relating to skeptical actions. No? And then I would like to show the next slide, but oh yeah, there we go. Way too fast. All right. These are the questions we asked relating to skeptical actions. They're self-developed based upon the paper by Catherine Cadu and Christine Noldo, actually, as well as information you find in the IAASB documents. And I think if you look at them, I mean, they clearly relate to what we intuitively, I think, consider to be skeptical things. Willingness to challenge assertions by management, willingness to be critical towards what other people of your audit team are claiming, and so forth and so on. So we had 8 different questions about that in total, and asking people to wait for that specific engagement, to what extent they actually engaged in these behaviors. Now, I did get an email from Remco, who was going to be the discussant, asking a question about to what extent people may be a little bit biased here. To what extent are people thinking that they're much more skeptical than they actually are? And sure, that may be a concern. I'm not too concerned about that for a number of reasons. Let me highlight one. If you look at the distribution of responses here, you do see that, sure, on a maximum of, I think it's 56, sure, people indicate that they are relatively skeptical, but there is clearly a lot of variation as well, and clearly not all of the auditors answering our survey were indicating that they were very skeptical on all these things. So clearly quite a lot of variation, and maybe already one caveat to highlight here. Obviously, something we cannot say based upon the research we're doing here and presenting here is that the auditors scoring low on this questions were doing insufficient work or anything. We can't say that they were insufficiently skeptic. They were just less skeptical than other auditors in the sample. We also have archival data which maybe allow us to do some of those analyses, but haven't done those yet. But what these data allow us to do, I think, and which is, I think, very interesting, is to look at to what extent these skeptical actions, whether they are sufficiently high or not, to what extent these skeptical actions are being associated with different factors that we often think, like you just explained yourself, that you often think are associated with auditors being skeptical, and see whether that's indeed the case and which of those factors actually have the strongest impact. Right, let's yeah. Oh. All right, let's do one interactive question. If you're still on the poll thing, you should be able to see a second question where you can actually rank different things. There's a whole bunch of things that we actually had included in the survey. So we had attitudes, motivation, specific audit knowledge, expertise, how committed people felt to their client, the fact whether they are inherently skeptical, social norms, importance of the client, feelings of accountability, and a couple of others. I hope all of them are clear. If one of them would not be entirely clear, just raise your hand and I'll explain what is meant by them. But you can rank them in what order you think is the most important one. So just drag the one you think are the most important 2 or 3 factors, drag them above. You don't have to rank all of them necessarily, but you can just drag the ones you think are most important to the very top. Oh, is that true for everybody? Oh, how do I? Oh, it should work now. It should work now, yeah. 317. 317. Yes.
Are all these factors positively associated, or are there also some that are like negative?
They're definitely not all positively related. Some of them are indeed negatively related, yeah. Right, I'll give you 1 more minute. I'm already getting some results on my laptop. You're not going to see it, obviously, which is maybe good, actually. It doesn't influence how you think based upon other people's responses then. It's warm. It's almost done. All right, I think well, still some movement going on. Although the things at the top don't seem to move that much anymore. The thing that has been consistently ranked first, and you can still keep on voting, it's not really changing the top 3 anymore, it seems. The thing that has the most being ranked on the top is actually, which is on top now as well, is time pressure, which is not entirely surprising if you looked at the results we previously got, because that was also the word popping up the biggest on my screen. Clearly, you all believe that time pressure is a very important thing here. I'll just mention the top 5 or something. So time pressure is on 1. You also think that the tone at the top of the firm is very important, that trade skepticism or being inherently skeptic is very important, that skepticism being rewarded in performance evaluations is quite important, and that a strong quality control system is quite important. And then all the things clearly rank much lower. I think the lowest 2 currently, although I can't all see them, are self-identification with the client and then expertise. Those are not scoring very high. Right, some of that actually matches with our data and our analysis, some of it not. So there's going to be some surprising results here, at least, I think. All right, let's have a look at what we actually found, and this is in a nutshell what we actually found. And let me perhaps start by saying what we didn't find. Unlike what everybody, or at least a lot of people of you, are thinking, time pressure didn't show up to be important at all in our data. Now, maybe one of the reasons there, I mean, I'm going to be a little bit careful drawing too much of a conclusion on that. One of the reasons may be that most of the auditors, and this may surprise you as well, most of the auditors in our survey actually indicated that they felt quite low time pressure when working on their engagement. I mean, and these were fairly randomly sampled, these engagements, so apparently time pressure in the Netherlands is not that excessive, or didn't used to be in 2016, 17 at least, or not as excessive as we may think, and apparently due to that not having much of an effect on skeptical actions here. What has a big impact? The biggest impact, very, very clearly, it's about 3 or 5 times bigger of an effect than any of the other things, is social norms. Basically meaning, what do you think that you are supposed to do? If you think that other people within your audit firm and within the profession at large and other people at the same level think that you should be acting skeptically, that very strongly affects, and it aligns with what we know from research outside of accounting and auditing as well, but that seems to be a very, very important thing driving people to actually behave skeptically. 2 other important things in terms of environmental characteristics turn out to be the focus of the firm on professionalism, the extent to which the audit firm is perceived by their auditors as focusing really on public interest, audit quality, rather than commercial values. That's having a strong effect as well. And somewhat related to that, also accountability. Accountability to the client, to the public interest, to the audit firm has a quite strong effect on auditors taking more skeptical actions. If they feel that they should be really serving the public interest, they're behaving more skeptically, which is good. I mean, all of these things are good. We also find quite some strong effects of trade skepticism, so inherently being skeptical. That's not that surprising, I guess, but it's quite interesting nevertheless, given that prior research has yielded mixed results on this. Also attitude, so I'll expect a question from Christine on that. But also attitude seemed to have a good positive impact on being skeptical. Motivation as well. And there we actually did notice quite a lot of difference between the participants responding to our survey. There was quite a lot of difference about how motivated people to do well on the engagement. And doing well or being motivated to do well was clearly associated with taking more skeptical actions. I mean, I think that's an important thing for people in practice. You want to keep your employees motivated. You don't want a whole bunch of people just sticking there in the hope that in 2-3 years from now, because they can put on that they worked for Deloitte or whatever for a couple of years, they're going to be able to get a good job outside of accounting. You want people that actually are motivated for doing a good job. Industry knowledge also has a clear effect, and specific audit knowledge about specific audit standards related to analytical procedures, for example. General audit experience, just how long have you been working as an auditor, doesn't yield any effect. So it's really specific knowledge about specific accounting matters and specific knowledge about the industry of the client that help you to be a more skeptical auditor. Yes.
Would already been, but so I ask a question about this. Where's the mirror? Because I look in the mirror in the morning, and then I say to myself, do I like what I do in terms of actually internal social norms? So, are the things that I do in my firm are they the right things? And the way that you explain social norms is more to do with how do other people think of what I'm doing. Same thing with accountability. Same thing with audit firms' focus. So where's the mirror, the morning mirror? Is that not present in?
Well, I guess that's present on the left-hand side a bit. I mean, the inherently being skeptical definitely is a thing. Okay, you personally inherently looking at the mirror. I'm a skeptical person, so I'm going to be acting skeptical. And same thing for motivation. I think it's mainly intrinsic motivation that we're capturing. And knowledge is I think inherently as well.
Virtue, is it? In words of Aristotle, it's a virtue.
Yeah. And I think, I mean, like, if we think about it, it may actually be good that the strongest effects are in the environmental characteristics, because that means that we actually can do something about it. I mean, if it's basically just about people being skeptical, then okay, you can do something about it as a firm, because you can try to select the most skeptical people, and you can make sure that those are the ones you keep within your firm and promote them and so forth and so on. But things like accountability pressures and things like social norms, that are clearly things that you can work on as an accounting firm. And as we learned yesterday from the very interesting talk by Therese and the collaboration with PwC, it obviously takes time to change those things, but it's clearly possible to change firm culture and things like social norms. So I think that's a really encouraging result. I have a lot of other slides, but I mean, just jump in with questions, I would say.
Wait.
Okay, Petra Tienstra. What do you mean exactly with the environmental characters? Did people say, okay, I need that to be skeptical, or was it that they define professional skeptical, then something like that has to be in an organization?
Okay, thanks for that question. Yeah, so with environmental, I basically it's just an overall term I use to group these different things. So it's social norms and accountability, but also the level of the quality control system, the performance evaluation system in place within the firm, the amount of ethical leadership. And actually, we had a little discussion about that in our team. We don't find that what we call tone at the top, but which is really about ethical leadership within the firm, to have much, if any, of an effect. And we were a little bit puzzled about that initially, but then if we thought, I mean, at least I think it makes sense if we think a little bit longer about it, because that specifically was about, the questions we asked there were specifically about, do you think that the partners in your audit firm are behaving ethically and stuff like that? And being skeptical is not necessarily, I think, about being ethical. It is about, indeed, having a good firm culture and social norms being strong, but not so much about behaving ethically per se, I think. So, any other questions? Yeah, go ahead.
Yeah, interesting. Yeah, do you mind?
Yeah, Kris, thank you for a very interesting presentation. I may have missed something, but I would like to know, these skeptical actions, that is self-assessed, right? I'm saying this because we know, of course, that people in questionnaires depict themselves as much more honest, favorable, etc., than they are. I understand that you don't have the actions themselves, you don't have proof. But I'm mentioning it because I didn't see it anywhere in your slides to say, well, this is only self-assessed. It's just a recommendation.
Yeah, I think I briefly mentioned, but I could talk about that for 2 hours, just that, I guess. But let me say maybe two things. Like I mentioned, there was clearly variation in the extent to which people assess themselves. And quite interesting, I don't have that on the slide here, but I had a quick look. We also had a question where people were asked to indicate how skeptical they think they are compared to other people at the same rank. And it's quite interesting that if you look at that, apart from people at the junior staff, overall rates themselves as much more skeptical than on average. They are all, pretty much all the junior staff think they're more skeptical than other junior staff. So yeah, there seems to be some overestimation there of how skeptical they are. The interesting thing is actually that you don't see the same thing for managers and partners actually. There you actually see about half of the people saying like, okay, I'm average, and some of the people saying I'm above average, and some people saying I'm below average. So that's, I think, quite interesting, and it also does indicate, I guess, that there's some learning going on within those firms, and that people at the manager and partner level are better calibrated in this sense.
Thank you. There's a question. Do you dare, or shall we? Okay.
One of my helpers. Hey, Kris. Interesting stuff. Thank you. While I think it's interesting to see which factors come out on the top of the list, it seems like it might even be more interesting if you're able to look at interactions and combinations. And I'm not quite sure how you would do that with your data, so I'm just kind of asking, have you figured out a way to find out, like, you know, if you're low in trait skepticism, then here are the environmental characteristics you need, or something like that?
I'm not quite sure if I have it on the slide, but it's a great question, and we actually do look at that. In general, there's not much going on there in terms of interactions, with one exception indeed. People that are inherently skeptical indeed are not so much affected by all of these factors as other people. I'm trying to remember by heart now. I think overall things like social norms, accountability, have a smaller effect for people that are inherently skeptical, which is, again, I think a good thing, because that means that the people who are inherently skeptical will behave inherently skeptical, whatever the environment will be, pretty much. And the people that are not inherently skeptical, we can overcome their sort of lack of inherent skepticism by making sure that their environment is strong enough. So, yeah, really good point, and we do have some analysis on that.
So I'm holding the box. I might as well ask a question, right? So I'm not sure if this is useful, Kris, but I can't help but mention it. Can you go back to the slide that shows the bar graph and the behaviors? So if you had asked the respondents that the attitudes and the standards that are mandated are an attitude of skepticism and also independence in mind, which, you know, we in the book chapter say is an attitude. If you had asked them, to what extent does the skepticism attitude influence behaviors, and what are those behaviors? Maybe you would have gotten a different response, you know, if you kept it separate from the independence attitude, because when you're looking at the attitude-behavior relationship, theory says that if you're measuring it, you have to take into consideration the attitude of interest, the attitudes that are not of interest that are affecting that behavior, and then there's random error. So when I'm looking at the sides, the wings of this graph, I'm thinking to myself, well, maybe they're low because maybe the attitude of independence was more of a factor when it comes to the client. And then when I look at the ones in the middle, I say to myself, well, is it really skepticism? Or if they had known about, if they had considered the attitude of independence, maybe they would have changed their mind and the ones in the middle wouldn't be so tall. Not sure if that matters or if how you're going to use it.
Analyze that if he can split this list
into ones with clients, ones that don't affect the, yeah, that's a great idea.
Let's discuss that further during lunch. I have to think about it.
I have to think about it too. We can talk. Thank you.
Sure.
So I wonder how this kind of plays into a broader question of audit quality, because it seems, I mean, it's really helpful to have this detailed analysis of skepticism, but on its own, I'm not sure this will get you to the really important things around, well, have I made the right judgment? So this might send me in the right direction, but I've spotted something I wouldn't otherwise have spotted. But I've still got to use my kind of diplomacy skills and other things to explore something with the client and make the right judgment at the end of the day. And so I just wonder, in the context of that kind of wider set of things that you need to be able to do, whether the conclusions that you had on the slide, so for example, I've got a trait that I'm particularly skeptical. I have motivation that I want to be really skeptical in this case. Perhaps I've got an axe to grind, as we might say. But those things might militate against you making good judgments, or they might militate against you having the kind of conversation with a client that's going to get you the result you actually need. And maybe you need to do those things in combination with others, as well as within yourself. But I just wonder whether, having got those conclusions, whether they kind of point towards other things and how they might fit together with those other characteristics.
Okay, Kris?
Yeah, great comments. I mean, I think, like I said, I'm a little bit hesitant to say, I mean, we don't know whether the people scoring low here are insufficiently skeptical. I mean, we don't know to what extent this translates into insufficient audit quality. Now, of course, if you look at inspection reports and regulators, there seems to be more concern about people not being sufficiently skeptical than they being overly skeptical. So I'm inclined to think that it will probably be positively correlated with audit quality outcomes as well. We do actually have data from Belgium also, where we look at inherent skepticism and the going concern reports that auditors issue. And find some positive relations there. But of course, also there again, you could question whether more going concern opinions are necessarily a good thing. Of course, it will depend a bit on the viewpoint you're taking.
Thanks, Kris. I just have a question to practitioners. Because this is about individual response, but we know that auditors work in teams. And I just have a question, because you're some partners here, that you have a team, do you consider the level of skepticism of your team members?
Well, good luck, Els, he says. Well, I think that's a good question. Well,
I will ask you in a moment as well.
Yeah. Well, first of all, I would like to say, well, we're working, of course, on how to improve our professional skepticism for a long time, and that is within the team or with a certain professional. And I think one of the most important thing, and that was what I was missing over here, was the effect of the experience of the auditor in fraud cases, legal cases, regulator inspections. You notice that if they experience such a case, then that absolutely directly affects their professional skepticism in the long run. So what we do is a lot of discussing, talking, dialogue with all the members of the team, and there the team comes in, Philip, the members of the team, what happened, why it happened, and I think that is, well, what I noticed from talking to our member firm, international member firms, that there is a difference between the Dutch culture and maybe the other cultures, because I think in the Netherlands we discuss those cases. So if you make a mistake or if there is a fraud case within your team or within the industry, you discuss it with everybody. Just going to stand up and say, well, this went wrong and this or that could be done better for the next time. And that really helps raising the professional skepticism. So my question for you was, well, whether you take that into account within your research, whether professionals experience such a kind of issue or fraud case or anything.
Yeah, we did ask about whether they had experienced cases of financial statement fraud or that sort of thing in their career, but I can't remember the exact numbers, but there were very few people that indicated that they had any experience with that, so making it essentially impossible to make any statistical analysis on that specific thing.
Any other question? Yeah, final question.
But for sure that will have very strong idiosyncratic effects, yeah.
I'm not sure. Should I? Are you as well? Okay, there we go. Yeah.
Yes. Now, René Schachman from PwC. Now, I think to respond to that, I think professional skepticism is obviously a topic which has been on the agenda for many years. I think if I look as a profession where we have shifted in our culture over the years, moving to indeed a learning environment, how do you create an environment in your team that people can speak up, be skeptical. But I think also if I look at myself as a practitioner, being available, being with your team, coaching your team members, and I think sometimes I do see, and I miss that word is confidence, because sometimes I do see younger colleagues being skeptical, wanted to be skeptical, asking the right questions, but going out there and challenge the client, which is often more senior than you are, more experienced than you are, but be confident that hey, I have the role as an auditor, I can ask these questions, this is my job to ask these questions and challenge these people. I think creating an environment that your colleagues, and especially the younger colleagues, because experience, I think it is an important topic, having been out there, having experienced cases, issues, dealt with issues and learn from those issues. I think that's important, but especially a big part of our teams are younger people. So giving them the confidence that they can do that and it's okay to do that, I think it's important.
Great, thank you. Any other question, final question, a question you never dared to raise, but now Kris is standing here. I'm going to raise this, yes, okay. I'm not going to show because this is a direction I don't dare to, so this is better. Yeah?
Okay, so Juliette Misawi from the Culture and Behavior team of PwC. I'd like to ask a question related to what Ranish was saying. So one of the first things that came to mind that I would think would play an important role, as if we're speaking environmental factors, would be psychological safety, which was just discussed. And then one of the top outcomes that you found were social norms. And I was wondering, how do social norms fit in the psychological safety construct? And how exactly did you measure that?
So for psychological safety is one of the survey was very lengthy already. Psychological safety was one of the things that was on our list that eventually didn't make the final survey. So can't really say too much about that. Will social norms have an impact on psychological safety? Probably yes. But social norms essentially is about what do other people do that you compare yourself to, and what do you think that those people are expecting of you? So in that respect, we clearly, and like I said, the effect is way much bigger than any of the other effects we're detecting. So if you feel that other people within your firm are being skeptical and that you think that they expect you to be skeptical as well, that will clearly affect your behavior. Whether psychological safety will have any additional effects, I really can't say based upon the data that we have.
Thanks.
May I have a big applause for Kris? Yeah, Kris, wait, because sorry, because yeah. because we are that grateful that I also want. Kris, thanks
Thank you
very
very
much.
much.
Thanks very much. And I think if I look into the agenda, it's 13:05, but it's now on my watch 13:10, so 5 minutes. And I have closing reflections. So that's for half an hour. No, I think, no, you will have lunch. And let me see where. It's in the central hall, so where you came in, there's the lunch in a moment. But I do have some closing remarks. I'm not going to summarize everything that has been told, and I think we learned a lot. And one of the sentences that's still in my mind, that we are social animals, and there's artificial intelligence coming up, and that it will have impacts on our judgments, and that the environment we are working in as auditors is very emerging. A lot of things are going on in ESG, and we have to detect fraud, and we have to be professional critical, so a lot of things. So there was this sheep with 5 feet or 5 legs in English? 5 legs, so it's a sheep with 5 legs. So a lot of things will change in coming years, I'm sure. So it's great that you are here and we have this discussion between academics and practitioners. And I have to, it's not apologize, but I know that the academics, and especially from the other side of the Atlantic, that the real discussion we have about papers is academic, and we go into methodology, and we talk about theory. But here we have this mixed audience. Now, before going on, could you please raise your hands if you're an academic? Just raise your hand. Right, thank you. And now, would the practitioners also raise their hands? No, okay. I'm amazed. Thanks very much. I was afraid that because of the time pressure and pressure on practitioners, most of them would have left already. But it's fine, they're here. So we are improving. It's progressive. This is great. So next year, I think there will be even more practitioners, because the discussion and communication between us, I already said in the beginning, different spaces, what we need each other. Auditing is no science, for sure not. It's a profession. An academic look into it. That's you can look into from an academic and research perspective in everything. So also in auditing. So it's very interesting and good that we do have this communication, do cooperate. And I told you I had some experience in past decades about trying to narrow the gap, and I think what's happening here is great and will help. This is the only way forward, I think. If there's some suggestions to even improve or make it better, that will be fine. And thanks to the professors who are here, some of them do have also an academic link, because that's quite common in the Netherlands, and they are here. But their task is also to share it with all the practitioners, and practitioners who are not that interested in research. But the findings are that important that they should be involved. So that's what maybe also something on the agenda for the FAR. So, closing. Thanks to all the presenters. Thanks to the discussions. Thanks to you all for all the discussions. And of course, I would like to thank Jan, Alexandra, and Harriet, and she's sitting here, the FAR, for organizing this, because I think this is very valuable for academics and practitioners. Enjoy your lunch.